Hello and welcome to ROBO Global's third quarter 2019 investor call. My name is Jeremy Capron. I'm the Director of Research at ROBO Global, and joining me on the call today are Lisa Chai and Nina Deca, Senior Research Analysts based in New York. Before we review our investment strategies, I'd like to provide a quick update on our company. ROBO Global is a research and investment advisory company focused on what we believe to be the next technology revolution: robotics, automation, and AI. And 6 years ago, we launched ROBO, which was the first robotics and automation index to market. And we now offer a range of research-driven equity indices covering artificial intelligence and healthcare technologies. And today, our investment strategies are tracked by around $2.5 billion in AUM, primarily in ETFs and mutual funds around the world. Our indices are based on a research-driven selection of best-in-class companies, combined with the discipline of index investing and a strong ESG policy. And as you can see on the next slide, we are fortunate to work not only with investment professionals, but also with an amazing team of industry experts, including some of the most prominent thought leaders in the robotics and AI world, whom you may get a chance to meet at our upcoming investor events. On this next slide, we show a recap of our indices performance. And while all three indices declined in the third quarter, you can see that the strategies continue to deliver remarkable performance over the long term. And they have outperformed global equities so far this year, as well as in the past 3 and 5 years. So let's talk about ROBO first. ROBO is a research-driven index of best-in-class companies in robotics, automation, and AI. And as you can see here, it has outperformed the World Equity Index this year, but also over the past 3 years and 5 years, with annualized returns of more than 11% in the past 3 years and 9% for the past 5 years. And particularly in 2016 and 17, when the strategy returned a total of 72% over just 2 years. Back then, robotics was essentially firing on all cylinders, from factory automation to surgical robots, warehouse and logistics automation, retail, food, basically all subsectors of the index performed very well. Last year, however, was a different story, and factory automation stocks were hit by weakening industrial markets and the trade war. In the third quarter, global equities declined marginally, and the ROBO index was down 4%, including a 1% headwind from foreign currencies as the dollar strengthened. Investors this year are growing increasingly concerned as manufacturing PMIs in advanced economies have dropped to the lowest level since the global financial crisis, and capital investments continue to slow. However, upcycles don't die of old age, and consumer spending in the US and China remains strong. The Fed just cut rates for the first time in more than 10 years and returned to balance sheet 5-year high. Saying that manufacturing indicators have been declining for more than 18 months and are already at levels where they have historically bottomed out. A resolution of the US-China trade negotiations would significantly improve business sentiment and corporate investment. And clearly, if there's one area where corporate investments are firmly set on a strong structural growth trajectory, it remains automation and AI. In fact, we believe the setup may be particularly attractive for robotics, automation, AI stocks at this juncture, which in many ways appears to be comparable to early 2016, which was the bottom in the last industrial cycle. The equities of robotics and automation companies are now trading on a forward PE of 22 times, which is in line with their 5-year average. And this is at a time when earnings and sales growth are inflecting. In fact, after 2 consecutive quarters of earnings declines, ROBO's median EPS growth appears to have turned positive in the third quarter and is expected to accelerate to 15% in 2020. For sector dynamics, we saw actuation, manufacturing and industrial automation, and sensing deliver positive returns in the quarter. But the other 9 subsectors of the ROBO index declined, led by consumer products, energy, and 3D printing. And by region, Asia outperformed. Japan was up 6%, Taiwan was up 5%, and Korea was up 3%, as we saw stabilization in order rates at several factory automation companies. Germany was down 16%, and the rest of Europe were also the largest detractors for the index in the third quarter. Now, let's review some of the big movers during the quarter. The top contributor was Ambarella, which was up 42% in the quarter. Ambarella announced design wins for its computer vision chip. And from its strong position in video, Ambarella is, and that is a move that enlarges its addressable market from hundreds of millions of dollars to a multi-billion-dollar opportunity. Ambarella management expects 5 professional IP camera suppliers to ship product with its computer vision chip by the end of the fiscal year. Another top contributor was Teradyne. Teradyne was up 24% in the quarter. The company posted a surprisingly strong set of second quarter results. They saw strength in their semiconductor test equipment, particularly for 5G infrastructure. And its collaborative robot business, that's Universal Robots, has slowed down. It used to grow at more than 50% annual growth in recent years, and it slowed down to just 10% last quarter. However, it continues to largely outgrow the rest of the factory robot market, as does its mobile industrial robots business. In terms of detractors, Blue Prism was the top detractor for the quarter. The UK-based robotic process automation company was hit by cautious analyst reports in August. We think the RPA market remains in its infancy, and we see significant growth opportunities for the leading players, including UiPath and Automation Anywhere, which are private companies that have recently raised capital at much higher valuations than Blue Prism. So this is a very interesting situation here where private companies trade on valuations that are multiple that of the comparable public company, Blue Prism here. And iRobot was the other big detractor for the quarter. The maker of the Roomba robotic vacuum cleaners cut its sales and earnings guidance due to the recent implementation of 25% tariffs on certain Chinese goods. The sales grew 15% in the second quarter, so very strong growth, but tariffs are likely to cost more than $35 million to the company this year, and investors are concerned that iRobot may not be able to maintain its earning power. On the next slide, you will see some of the changes to the ROBO index at the end of September. We had 3 new inclusions and 1 exclusion. iFlytek is a Chinese company and a market and technology leader in AI, with particular strength in natural language recognition and synthesis. iFlytek has a fast-growing open platform for AI and applications in some critical industries, including government and consumer. ServiceNow is a leader in digital transformation for enterprises, and it provides business process automation solutions. The company now operates 10 data centers, and it has acquired over 8 AI companies in recent years. The third inclusion is Vocera. Vocera is a communication provider, a communication technology company that removes the friction involved in patient care, primarily in hospitals. Vocera is most known for its software platform and its badge, which is a small, hands-free, voice-activated device that's used by employees to communicate with one another and to get the right person to the right place at the right time in the hospital. And finally, Oceaneering, the maker of submersible robots, was excluded because it has become overly dependent on cyclical forces outside the company's control, primarily the oil price. Finally, on the next slide, you'll see some of the key characteristics of the ROBO portfolio as it stands. And I think the key word here is diversification. Diversification across sectors, from manufacturing and industrial automation to healthcare to food and agriculture and core technologies like computing, sensing, or integration. There's diversification across countries with more than a dozen countries represented, and also diversification across the market cap spectrum with a strong tilt towards small and mid caps, which account for nearly 70% of the portfolio. And you also see here that the overlap with traditional market indices such as the S&P 500 or the MSCI World is very low, under 3%. So investors generally don't own these stocks. And with that, I will pass it on to Nina Deca to discuss HTEC.
Thanks, Jeremy. So at the end of June, we launched our newest index, the Healthcare Technology and Innovation Index, HTEC. HTEC is a strategy that's comprised of over 80 of the most disruptive companies in healthcare. And here's how it works. So we look for technology market leaders across 9 different subsectors. One of the examples of these subsectors is telehealth. There's a business model within telehealth called telemedicine, where a doctor and a patient can have a doctor visit remotely, either on the phone or via video conference. Another subsector example is genomics, and we're seeing a lot of innovation in genomics, specifically in gene sequencing and also AI used for more powerful gene sequencing. So we'll dive into the actual, okay, so the most notable performers of HTEC during the quarter are listed here. We have Nevro, which is the market leader, one of the market leaders in spinal cord stimulation that's used for pain management. And during the quarter, the company had one of its products in its pipeline receive FDA approval preliminarily. Nevro had another win when an injunction was placed on its competitor Stimware during the duration of the two companies' legal battle, which is expected to continue on for another couple years. MedPace is a contract research organization. So 2/3 of the world's drug manufacturers outsource their R&D to companies like MedPace. This company has a strong focus on small biotech companies, and since there are an increasing levels of R&D investment in small biotech, this has been very positive for MedPace, as seen in the quarter, where their win rates were up 40 to 50%. Fluidigm didn't have as much luck this quarter. They're a market leader in mass cytometry, and shares traded down after a disappointing earnings print, largely dragged by the microfluidics business. But that said, cytometry as a market is expected to continue growth over time, and Fluidigm, we believe, is among the best positioned to capitalize on this growth over the long run. Axogen is a technology leader in nerve repair, also had a disappointing quarter due to delays in productivity, but they're investing in sales force expansion, and they're already seeing traction from their efforts with this, with a 20% increase in their active accounts reported in the quarter. So then we'll transition over to overall performance in the sector. As I mentioned earlier, we segment HTEC into 9 different subsectors as listed on the right. You'll see data analytics, genomics, et cetera. During the quarter, the winners were telehealth and regenerative medicine led the laggards of our subsector performance. Another part of our strategy, similar to ROBO, is a quarterly rebalance, during which time each of the companies in the index receive a score. And this is also a time where new companies might get included or current companies might get taken out. Among the new companies, we've got Insulet. They are a company in our medical instrument subsector, and I'll touch more on those later. Vocera is another new inclusion. We heard about this one earlier in this presentation because it's a new inclusion in ROBO. It also made the cut in HTEC because it is a tech leader in its communications products, and they are increasingly improving healthcare worker efficiency and patient safety. An example of what they do, similar to what Jeremy described, is their hands-free wireless wearable badge that is voice activated. We classify Vocera in our data analytics subsector. And then of the companies we said goodbye to, Medidata got acquired, and Nectar's score fell below our minimum threshold in our scoring system. Now we're going to highlight a therapeutic indication where we're seeing a lot of disruption, diabetes. In the last 40 years, the world diabetes incidence has increased fourfold to exceed over 400 million people with diabetes in the world today. So if you're a patient suffering with diabetes, here's what you have to do. You have to stick yourself lots of times a day using finger sticks to measure your insulin levels. And then based on those readings, you might have to administer yourself some glucose injections. So lots of needles involved, and there's a lot to remember, there's a lot to manage. And so there's a massive industry in helping people manage diabetes. In fact, the diabetes market is growing right now at a 24% CAGR and expected to reach $26 billion by 2025. And so here's what's driving that growth. A lot of innovation in this space to help disrupt and help patients manage this, as I mentioned. So some of these finger sticks, people have come up with continuous glucose monitoring, also known as CGM. And Abbott is one of the makers of a CGM device. And the neat thing that's happening with CGM over time is that it's getting smaller, easier to use, and there's new innovation that's in the pipeline or already approved around the world that enables not only for the glucose to be monitored continuously, but then report it via Bluetooth to an app in a smartphone device. So the app can even go as far as to give you an alert if your levels are high or low. So what this is doing is it's taking a lot of the management needs off of the patient and making it more passive and easier to manage. And another example of new technology is the administering of the insulin. Once you get your glucose reading, rather than having to inject oneself with insulin, they can use a pump that will automatically administer the necessary levels. Well, when I say automatic, what I mean is you can press a button, which is better than a needle stick, but there's new technology in the pipeline that is trying to create an artificial pancreas so that you no longer even have to push the button. It will automatically read your glucose monitor and administer the insulin. Announced a partnership with a company called Tandem, where they're going to put their heads together and try to come up with a way to develop this closed loop system. Abbott's revenue is growing at about 7.5% organically, and the company continues to be focused on margin improvement. Dexcom is another leader. Last year they had FDA approval on their G6 CGM, and it's basically interoperable. So they were the first to come up with a technology that would report the glucose monitor directly to the smartphone or other ways of reading it. And Abbott's got one in the pipeline right now that should be FDA approved, expected in the next year in the U.S., and it's already being used globally. Insulet, as I mentioned earlier, is a new inclusion to HTEC, and they are the creator pain-free insulin pump that replaces the need for these daily insulin injections. POD is the ticker, and this is another company that might someday partner with one of these CGM providers to help develop one of these artificial pancreas closed-loop systems. I bring up diabetes as a theme because I think it's a good example to highlight for you the exposure that we have to the medical instrument subsector in the HTEC portfolio. This next slide, if you look at the upper left-hand corner, you'll see the medical instruments subsector does comprise a large slice of our portfolio, but then we have a very diverse spread across several other of these technology leading subsectors in HTEC. And If you look at the bottom middle of the chart, we want to call out the market capitalization breakdown. The two lighter blues are the portion of our overall portfolio comprised of small and mid cap. And if you look to the right, that means we've got a median market cap of $6 billion. And this is different from the average market cap of $20 billion. But what this is it's giving us some exposure to some of the fastest growing and most nimble companies in healthcare. Another point of differentiation from the HTEC index is seen on the upper right corner. HTEC only has a 4.4% overlap with the S&P 500. So a back test of HTEC can show that that this index has outperformed the global healthcare and the world equity indexes over time. The typical healthcare fund has about 50% exposure to large cap pharmaceutical companies. And we think most of the innovation is in the other healthcare technology sectors. So on the right, you can see an example of this. We've compared HTEC to the Global Healthcare Index outweighs HTEC with pharma and provider subsectors versus HTEC, which is more heavily weighed in equipment and technology leaders. Now I'm going to pass it on to Lisa, who's going to talk about Think.
Thank you, Nina. The Think Index is a strategy that captures the mega trend of artificial intelligence as companies, small or large, are seeing acceleration of growth from the AI deployments that's occurring around the world today. We believe that AI is poised to touch every sector, and industry groups grow globally with spending in the hundreds of billions dedicated to implementing and enabling AI over the next decade or so. We believe that we have identified a unique strategy and methodology to capture this opportunity of a lifetime. For the year, the Think Index had a very strong performance, returning almost 24% year to date. But like many other strategies out there, the third quarter was a challenging quarter for many of the subsectors for the Think Index, as fears of slowdown in enterprise and consumer spending took over investor minds during the quarter. The best performing subsectors for us were semiconductor and factory automation, while the worst performing subsectors were in consumer and e-commerce. And the reason for the outperformance of semiconductor was that the industry began this year on a weaker footing with higher than expected inventory that needed to be worked down. However, in third quarter, trends reversed and the fundamentals in the semi industry began firming up, driven mostly by strong 5G deployment and builds in the high-performance computing and AI applications. Meanwhile, consumer and e-commerce subsectors were relatively weak, driven by mixed earnings results and negative sentiment surrounding the spending environment, and also elevated expectations from the group, as these subsectors were very strong performers at the beginning of the year. There were many notable performances during the quarter. On the positive side, Cloudera, enterprise data cloud management company, who reported better than expected second quarter results and raised guidance, which reassured investors as their new product launch is finally getting some traction. Cloudera faced some difficulties earlier this year as the merger integration with Hortonworks proved to be more difficult than they had anticipated. But stock had a good recovery during the third quarter, up 68%. Meanwhile, ASML Holding had a good performance, up nearly 20% during the quarter. ASML is a Netherlands-based provider of advanced semiconductor equipment, and the company continued to make new highs during the quarter as benefits from strong orders and sales of its long-awaited next-generation EUV machines were better than expected. While most equipment makers forecasted declines in 2019, ASML management has been guiding for another sales growth year in 2019, as growth will be centered on the foundry and logic segments for their EUV machines, which really enables production of today's leading node chips supporting deployment of 5G and AI technologies. In terms of detractors, a company called New Relic, a cloud-based analytic company, faced some difficulties during the quarter with weak revenue outlook as longer sales cycle and its newly launched integrated platform in the application performance monitoring market is taking longer time to get traction. To address some of these concerns, the company is in the process of reorganizing its sales force, and they also replaced some key leadership roles to accelerate sales growth. Netflix also underperformed during the third quarter. We believe that long-term positioning remains strong to drive strong global subscriber and pricing growth, but the decline in paid subscribers in the U.S. over the past quarter raised some concerns regarding its competitive landscape. That has gotten increasingly competitive. Meanwhile, for the third quarter rebalance, we did have a few changes during the quarter. Just to highlight a few, we added Rapid7, a cybersecurity company specializing in threat intelligence, and Arista Networks, a data switch company providing for applications in artificial intelligence and serverless computing. And we removed two companies, Metadata and Tableau, as M&A activity continued its momentum during the quarter as the race to add AI talent and advanced analytic technology to its product portfolio. This slide highlights portfolio characteristics of its broader AI ecosystem and its global exposure. And it's important to point out that it has a very low overlap with MSCI World Index, as well as S&P 500 Index and various other global tech indices. Investing in Think Index, the back test indicated that AI fund returned a total 56% in 2017. And a 3-year back test from 2015, the AI index returned a total 115%, outperforming the larger world equity index. And I'm now going to turn it back to Jeremy for the closing statement.
Thank you, Lisa, and thank you all for listening and for your questions. In the interest of time, we will answer your questions offline. So please don't hesitate to reach out directly to our team with any question, and sign up for our newsletter, which goes out every other week with investment research and important developments in robotics, AI, and healthcare technology. Goodbye, and we look forward to speaking to you again next quarter.